Monetary policy is an AD management uh, policy that the Federal Reserve is in control of. Unlike fiscal policy, which is controlled by Congress, the Federal Reserve is in control of monetary policy. And this is the way the Fed can manipulate aggregate demand through changing the money supply. The Fed has three main tools for changing the money supply. The first tool is the open market operation, or the OMO. And that's when the Fed goes into the open markets and buys and sells government bonds with individuals and with banks. The second tool the Fed has at its disposal is the control over two key interest rates. One is the discount rate. The discount rate is the rate at which banks can borrow directly from the Federal Reserve at the discount window. And the Fed funds rate is the rate at which banks lend to each other on an overnight basis. The discount rate is a stated rate. The Fed just sets that. The Fed funds rate is a recommended target that the Fed sets. So the Fed sets a target. On any given day, though, the Fed funds rate may deviate slightly from the target rate based on supply and demand for Fed funds on that given day. And the third tool the Fed has is the reserve requirement, and that is that the Fed can change the percentage of deposits that banks are required to hold on hand, and by changing that, the Fed can influence the money supply. So, of course, monetary policy, just like fiscal policy, can either be expansionary or contractionary. So, when the Fed, an expansionary open market operation, that's why it's OMO, it's a lot easier to say, is the Fed buying bonds, and the Fed can contract the money supply by selling bonds. On the discount rate, it's expansionary to lower either of these rates and contractionary to raise them. And when it comes to the reserve requirement, lowering the reserve requirement is expansionary, and raising the reserve requirement is contractionary. It's also a point to note that these are listed here in order from starting at the OMO and down, where the OMO is the most frequently used piece of monetary policy. Next is that open market operations happen daily. Changing the discount rate and the Fed funds rate, those happen generally at the Fed meets every 6 weeks to make interest rate policy. That's usually when changes occur. Now, the Fed can hold an emergency meeting and change them anytime they want, but generally those are up for review every 6 weeks. And the reserve requirement hasn't been changed since the savings and loan crisis of the 1980s. They're also listed from OMO on down, from the most fine-tuning to the crudest of the policies. So OMOs can be done in any small incremental amounts. I guess the discount rate and Fed fund rate usually can be changed in small quantities too, but those changes have larger impacts, and even small changes in the reserve requirement have very large impacts on the money supply. So that is not a very fine-tuning mechanism at all.